The lowest total number of up months has always been September. And then the second one is February. The most down months is September, followed by
How far does this go back to? 1926?
1928.
28. Okay.
So that's a lot of data. This is the S&P 500. Here's your
Yeah.
average percent up or down. Now, when September's down, it's an average of 4.7. When it's up 3.2. You can see your cumulative for other months. You have your average percent change each month. September, minus 1.1. That's taking the average of all this time. So this is like, what, 40, nearly 95 years?
Hey everybody, Bob Iacchino here. Welcome to the Futures Edge podcast. We are without Jim Iorio. He was canceled by social media, so we will not have him back on ever. I'm just kidding, obviously. Jim is on a well-deserved and mandated vacation, so he's not with us today. But with me, as always, beginning of the month, we're recording on September 5th, so this won't be released for a few days. And you guys know already, if you've been watching the show or following us for a while, that the beginning of the month, we try to have Mike Arnold, who is the chief technical strategist and the co-founder at Path Trading Partners, to go over what markets are looking at from sort of a technical and price action perspective. Mike, it's good to see you again, buddy.
Good to see you, Bob. So I scared Jim away, huh?
You scared Jim away. Jim said, I can't be on the show because Mike's always changing my trades. And actually, it's funny. I want to do something different here because Mike Arnold is, in my opinion, one of the top, let's call it top 3 technical strategists that exist. So that this leaves everybody watching this show their opportunity to put their own favorites in that 1 or 3 slot or 1 or 2 slot, whatever you want. Jim likes to go over the short term, week, 2 weeks out. And that's because he's always trying to figure out if he's got a good trade on or if other people who have trades on are good. And before we go into any charts, which I'm glad you have an S&P chart up there, let's leave that up there while we talk about this. I've had a couple of conversations on X specifically, formerly known as Twitter, about what technical analysis is and why it matters. Specifically, somebody asked about the specific chart that showed that there was going to be a positive court decision on a Bitcoin ETF that was going to drive Bitcoin back up toward those $24,000, $25,000 levels that it ran up to after that court case happened or after that decision happened, that the SEC was going to allow more Bitcoin ETFs. And my response was that technical analysis is about the what, not the why. So there is no chart that shows there was going to be a favorable ruling in Bitcoin's favor, but there may have been charts that showed that the likelihood of Bitcoin going higher rather than lower, that the probabilities were in that favor. Now, let's not look at Bitcoin for that, but if you could explain to some people why technicals are what you follow and what you look at for 99%, actually for 100% of what you do.
Because you can, if you do technical, and I'm not just talking about looking on the internet or watching a YouTube video and go, oh, that looks like a neat indicator, I'm going to include it in my trading. If you really study technicals and study ways that are concrete, not more abstract, for example, I'll give it some more abstract stuff that I do follow that still follows the technical analysis would be some Elliott wave, although I've tried to make that more concrete. Once you have something like we use harmonics, we can measure exact percentages. Okay, if it closes above or below this harmonic, what's the likelihood that the move continues or reverses? And now that likelihood could vary a bit by market, by asset class and everything, but you can assign a probability to it. And then I can work with probabilities to structure trades. Instead of just guessing, I can say, all right, there's roughly a 68% chance that this move should continue over the next 2 to 3 weeks, which, from just a fundamental standpoint, fundamentals and I look at fundamentals for long term stuff, like when we shift into a value mode in stocks, or I'll look at some core fundamentals based off metals or oil. But again, the technicals can remain in control a lot longer. People can say, I'm bullish oil, and it could go down for 6 more months and before the bull trend kicks in. So even if I look at some fundamentals and say, oil should be really going up or oil should be really going down, I can't be wrong by 6 months. I need to fine tune my levels. I need to fine tune the entries and exits. I need to also know what are the probabilities, even within the range. Let's say it's 65 to 70%. What are the probabilities of this move continuing? What are the probabilities of it reversing? What are the probabilities of this being a bottoming formation, a topping formation? What are the probabilities of this being a pullback rotation trade? So I can't do that just from a sole fundamental or based off of what the talking heads on TV or the latest headline is going to tell me. I've got to have a chart pattern. Can we jump to Bitcoin real quick though? Because
Yeah, please go.
we'll look at stuff, but I wanted to show something because it's already happened, so it doesn't matter.
Right.
But you said the court decision. That was this bar right here. Okay?
Yeah.
Big green bar. You know what happened? Before that, what's this pattern that never got invalidated?
That's double bottom.
Double bottom. Triggered. Mm-hmm. Then it went sideways for a few days. Then you had the court decision. Boom. Went through and why do we have a final target? Because that's the most likely probability area where if it's going to stop, it's going to reverse. Yes, did it go beyond it to another key level slightly? But look over the next 2 days. Boom, boom. Back down to where it started. So, double bottom. I would not have known there was going to be a court decision this day that was going to be released, and that would not only that it was going to be released at that specific time. We all had it in the back of our minds, but that it was going to rule in, or more so against the SEC and in favor of, all right, you guys got to go back. You can't just disqualify the ETF based off of this. And boom, shot up. So, it triggered, moved sideways. None of this price action invalidated. So there was a percentage that once this triggered, even with the pullback, hey, this has X percentage that it was going to go to these targets. And it went there and then reversed. And now we're back to where we're sitting now. Just like if I zoom out and then we'll get back to some other stuff, I know we have a massive potential double top that is not confirmed or triggered yet in Bitcoin. If that does trigger with a weekly close below like 24,750, and that's a weekly close, we could end up back at around 18,450 if all the targets play out.
So I just want to clarify some things here, and you can stick with this one. So as a technical analyst, you're not saying, and this is where I think people get lost, you're not saying that there's 100% probability it goes to that level. You're saying that if it triggers, the probabilities favor it going at least to target number one.
Probabilities favor, and there's a probability associated with target number one, a probability associated with target number two, and a probability associated with target number three. And then after target number three, why do we use 3 targets? Because after the target number 3, the probabilities that it's going to continue drop off significantly unless we're at a long-term pivoting level.
So is it similar then, and I want to put a couple of like sort of anecdotes around it. Is it similar to, let's say there's a problem with a car engine? All right. I'm talking about car engines that we used to be able to work on, right? So it won't turn over. So the first thing you check is the starter. You used to touch the screwdriver to the side of the starter motor, right? Say, okay, the starter's working. Is there spark? Well, the first thing you'd look at, is there gas? Is it turning over? Does it need a charge? Same kind of thing to where when you see a certain pattern, the highest probability is that it's the simplest thing. There's no gas in there. And then the next highest probability is maybe the starter or the spark plug, et cetera. Is that a similar thing in terms of probability? Because one of the things I get from people who are not technical analysts, they say, well, where do you get these probabilities? And it's from all the past data. The same place everyone gets the probabilities for everything. What has happened in the past has a probability to the idea that it might have happened in the future. Is that correct?
Yeah, that's correct. And for example, all right, let's say this pattern we're looking at on Bitcoin, if it does trigger, first of all, the pattern might never trigger. We could hold down here and then rally back up to 30,000 or above, and the pattern would be invalidated. So, that's with your, all right, maybe you're low on gas and you're pulling in that gas station before it runs out. And you make it to the gas station and then you fill up. But if this, let's say the car dies along the side of the road. All right, what's the most likely thing? Let me check the gas gauge. Oops. Well, gas gauge check number one is the first target. That's the most likely thing that happens. You don't go, maybe, I cracked the engine block. that's that's not where you're going to start in terms of probabilities. Your next thing could be, maybe it just overheated. I see some steam coming out. All right, maybe it's just overheated. And then you go down. But that's why and some patterns have one target, some patterns have three targets, some patterns have a multitude of targets. But us being able to associate also taking an action, for example, we know, and then these can be structured many different ways, but the general rule of thumb is it hits the first target at a bare minimum, you're changing your stop level. All right. So we know that, hey, if it hits this probability with 73%, I should lower my stop because this is the first area that it could be reversing. Next, then you could take subsequent actions on the next two targets, whether it's lowering a stop, raising a stop, taking profits, taking partial profits. That's all in the trade analysis, or trade setup. But if you don't even have a probabilities and levels, some people just guess. They're like, well, if the market goes up 10%, I'll do this. Well, why? What's magic about, unless you have a probabilities associated that this happened and the market should go up 10%, then, and we'll get to that with the returns on the month basis because there are historical things on that. So unless you're using something like that, you're just pulling it out of the magic bag, and pulling it out of the magic bag might work sometimes, but not consistently for long-term trading.
So another example I'll give, and this is a real world example for people who don't know, Mike and I have been partners and bad trading partners for a long, long time. And I remember the salmonella outbreak at Chipotle. Now, off the top of my head, I can't remember what year that was. That's actually what I'm looking at over on the left here. But I remember there was a salmonella outbreak. The stock took a big hit. And I was driving into downtown Chicago about a week later. And there was a downtown Chicago Chipotle, and I saw the line out there, and it was just as long as any of the other lines I'd ever seen at this particular Chipotle. And I remember calling Mike up and saying, I want to buy Chipotle. And Mike pulled up a chart, and he said, not yet. And if I remember right, Mikey, it was a long time before you told me that it was okay to buy Chipotle. And I'm not saying you picked the low, but it did not go back to the lows after you told me it was okay. And when I wanted to buy it, it continued substantially lower. And your only reason for that was technicals and price action. Am I right?
Correct. And again, we're not trying to call, even with double tops and double bottoms, you're still not calling the exact high or low. You're calling a high area or a low area. But you know what? I'd rather have the probability shift in my favor on anything. I don't, like, let's just give a nice round number. This varies on the markets, whether it be futures, stocks, ETFs. But let's just call like double bottoms a 70% probability that it will go up. Do I want to be betting on that 30% or the 70%? So if I don't have a clear bottoming pattern yet, or I have other things that say, hey, we should continue lower to this next key harmonic level at this 68%, unless we get a double bottom pattern, then I don't want to bet against that decline. I don't want to just try to buy bottoms and be wrong. Or like a lot of people, they try to buy a bottom and it goes against them. And they're like, oh, well, I guess I'll just turn it into a long-term position. And, which I'd rather have the capital working for me. That doesn't mean every trade is going to be right, because nothing's right 100%. But I don't want to be in a trade. Like, I don't want to be in a Chipotle. I'd rather give up a few percentage points in returns than sitting there for 2 years waiting for Chipotle to turn around.
Finally found it. I think it was 2015. So like the first outbreak was July, and then there was another one in August, another one in September, and the stock just kept cascading from there. But I digress. let's talk about current markets. Again, we're recording Tuesday, the 5th of September. You guys, if you're watching it the minute it drops, you'll be watching it sometime Monday morning, which would be the 11th. So let's talk about September as a whole, because we both know that historically September is the weakest month in terms of returns for stocks. So what do you know about the actual weakness that
Ron,
September brings about?
this is from Stock Market Indicators Historical Monthly and Annual Returns. This is done by Dr. Edward Yardini and Joe Abbott.
Mhm.
And I just know from, I haven't vetted out everything in this presentation, but I know from my numbers that I remember roughly from the top of my head, this is pretty spot on. I have no reason to doubt their research is not 100% correct.
Yeah, I
This
mean, you
is
can't get much more credible than Ed Yardini and
no,
Yardini Research. So if he's
no,
wrong on any of this, it's a slight error. It's not going to be
yeah,
anything drastic.
this is not be something. This is not like Mr. X put out on Twitter,
Exactly.
Let's just take a up or down each month. 1928 through 1920 or 2023. This is not. We're recording at the beginning of September. This was revised at the end of August, so it does not include this September 2023's data, of course. But if you see, the lowest total number of up months has always been September. And then the second one is February. The most down months is September,
How
followed
far,
by
how far does this go back to? 1926?
1928.
28. Okay.
So that's a lot of data. This is the S&P 500. Here's your
Yeah.
average percent up or down. Now, when September's down, it's an average of 4.7. When it's up 3.2. You can see your cumulative for other months. You have your average percent change each month. September, minus 1.1. That's taking the average of all this time. So this is like, what, 40, nearly 95 years?
Wait, I'm sorry. What's the difference between those two charts? The one you
So
just showed in this one?
this is how much it would be if the month was up, which out of the 42 months that were up in September, the average increase was 3.2. Of the 52 months, this average decline was
Gotcha.
4.7. This
Gotcha.
is if you do the percentage change each month, just the overall percentage change. September,
Gotcha.
you see, has the worst percentage change.
Gotcha. Okay.
The next
By
one
far.
is February and May.
Yeah,
So
that's by far.
okay. Now, the other interesting thing is if you look at October tends to rebound a bit, a lot more positive months. But here's a little thing, and we're again not trading advice. The first 2 weeks of October tend to be more volatile and more prone to some downside shocks. So, from my consideration, if I was looking to structure a hedge for September, October, at least the beginning of October, I like to structure hedges that go through options expiration, major options expiration in October, because you can start getting through the beginning of October. Your hedges are going to start expiring. And then if you look for starting to really even the middle of October, but even if you start finding a bottoming pattern earlier than that, you have 56, 58, and 69 up months for October, November, December, and you can see 0.6, 0.9, 1.3. So if you can avoid any big losses or put on some hedges for your portfolio, September rolling into beginning of October, you can start rolling out of them. You could have a bad October, November, December, but historically, I'd rather be trading with the percentages and the probabilities going into the end of the year and let my hedges expire unless there's something else that says another overriding, like let's say we triggered a major monthly double top pattern. That might be a different consideration. But unless if we're in standard market conditions, start shifting to bullish sometime in October. And because we have probabilities associated with it, and we have percentages to expect, and then you can drill down farther and look at annual, all the percentage changes. So you could really get into dive in here, but this will even give a solid foundation for at least statistical and probability wise of what you can roughly determine, so you can structure a portfolio or a longer term trading plan even around this kind of information.
So it's interesting to me and I've had this conversation with people, and I'm not sure that I have sort of my argument structured in my head. So I've never taken it really that far. But I always tell people, when people tell me they're 100% fundamental, and I'll say, what do you mean? And they say, well, I look at, EPS and forward 12-month earnings and things. I'm like, well, that's technical, because at the end of the day, you're boiling it down to numbers versus historical, or numbers versus expectations. And there's probabilities in your mind based on what could happen on that. Now, if you're just saying, I think AI is going to grow by 200% a year, even that 200% a year is kind of a technical target for you. So, like, everything essentially boils down to figures in my mind. And that's why I never understand how people just kind of throw technicals away and say, oh, that's just voodoo. Or, yeah, a friend of mine, Scott Nations, really good friend of mine, better friend of Jimmy's. We used to be futures now traders together. One time said, oh, that all just looks like lines and squiggles to me. And okay, fair enough. Your fundamentals are kind of technicals as well. Because if you're looking at things and saying, well, this is what typically happens in the past. So, for example, a stock typically is overvalued at X EPS, right? If it reaches a valuation of this, stocks are typically overvalued. It's based on historical numbers. Again, I don't have that argument kind of fully vetted out because I just don't have it that often. Yeah, so that's what I'm saying about that.
Now I'll look at fundamentals because I'll cite growth versus value, but other things, and you can get even with in the market in the last couple of years. We've had growth stocks that have gone to, and there still are a number of them, like Nvidia, even though it's growing. The fundamentals don't uphold the valuation at all. But would I be shorting it? No. Now we get a topping pattern. That could be a time because it's not only overvalued, it's triggered a technical pattern too. So I'm just not going to say, hey, something's overvalued, I'm going to start shorting it. Or we've seen this with value stocks or things that have been beat down. Oh, this is way undervalued. Well, for the next 2 years, it remained way undervalued. Now, if it's undervalued and there's a double bottom pattern that triggers, that's a different story because now I got the fundamentals and I have the technicals.
It also gives people concrete direction. I've seen certain TV traders that are still on a certain network that I just don't like. And they'll say things like, this stock's going higher because of XYZ. If it gets back down to 200, I'll buy it. They'll just pull a level out of their proverbial asses. And generally, it's somewhere where they see just your sort of vanilla support and resistance on a chart because they don't just want to buy it here. That's technical. It's terrible technicals, but it's still technicals. It's not a very educated view. Let's go right into, now that we're talking about, and you showed kind of the evidence of September historically being the worst month, let's look at some of these indices and see what you're looking longer term. So in other words, if we put up, start with whatever you want, S&P, Dow, I don't care. Whichever one you put up, if we actually get any sort of negative September, is there anything sort of on the chart here that tells you that there could be sort of a cascading effect despite October, November, or let's just say the fourth quarter of the year being historically positive?
Now, this is based off of these levels. I have to do something based off some point in time. So these are based off of the 24th of August highs in the S&P. If we take out those highs, the levels I'm citing will shift up. And then you'd have to jump on and watch me on YouTube to get the updated levels, which you can always ask for. Say, I heard you on the podcast. What are the updated levels? But let
me throw in there now, that's Path Trading Partners YouTube channel. Mike does a bunch of technical analysis live streams on there. So you guys should subscribe to that if you're watching this. Go ahead, Mikey.
And you're welcome to just jump on and say, hey, I heard you on the podcast. What are your updated levels? And I'll tell you. There are no big secrets here. So if we start pulling back and take out mid-August lows, that would be from the week of the 14th. And those lows are 4350. If we start taking those out, the last key support is around 4,200 in the short-term basis, which would take it below this channel, below the 50 EMA, and below a 37.5 harmonic. If that happens, the key area I'd be watching, unless the bottom completely falls out, is between 40.68 and 39.27. If we close below 39.27, the probabilities then favor a potential return to last October's lows, which happened between the week of the 10th and the 17th in the S&P. So that would be crisis mode then. Something really had gone wrong. Not expecting that to happen at this point because the trend is still up to potentially sideways. But
let's reiterate that part, Mikey. So you're saying if this happened, catastrophe mode goes here, but you're not expecting that to happen as of December 5th, Monday or Tuesday.
As of September 5th, there's nothing on the chart that says that's disaster mode. Now, keep in mind, what I'll be more prepped for is if we do rally closer back to 4,600 and then we close below 4,350, then we would have a valid potential double top pattern that would trigger, and then something like that. And it's not even there yet, but since I'm only on once a month and the next time won't be October, we could easily see the pullback to this 4067. That's so funny because I just put up some of the potential targets, and that 50% level I mentioned before comes in exactly with the third target on the double that's not even there yet. It's funny how that works, but that could be something that, all right, then I'd say concretely, now I'm focused on that 4068. We start breaking down through there. Right around that 3927 level, you also have the 200 week. The last time we connected with the 200 week simple moving average, it's the highest probability longer term moving average. Look where the bottom formed last October. We hit it September, October. We had a little dip below it, but look at that. Look at that bottom form right against there. So if we did come down there again, that would be right. We have a lot of things converging at key levels. That does not mean that has to happen. We could keep going up. Again, the probabilities still favor at least some of these levels holding. However, if something changes, and it being September, that's what we have to prepare for.
So we get questions all the time. Are you bullish or bearish on stuff? None of this means you're bullish or bearish, correct?
Well, in the short term, we're not going to spend much time on daily charts. On the short term, we've hit the first this is on a daily basis. So we're getting a little pullback now. We've already hit the first target of the double that triggered on the 29th of August. So in the short term, after this pullback, because it still favors at least a short-term pullback, we could easily get back up to this 4592, 4600 level in the short term, but that would even satisfy the potential bigger potential double top that might never potential trigger. Remember, people get confused with this all the time when I cover stuff. It's like, well, you said there was a potential double top, and I'm like, yeah, but it never triggered, and then the market continues. What that means is we have a valid pattern that's just could never trigger. But I know that if it does, I better be prepared. Until that time, what is it? The trend is your friend until it ends. Well,
people get mad at technical analysts the same way they get mad at weather people. They'll literally say, look, there's a 60% chance of rain, so you might want to bring your umbrella, right? And then people bring their umbrella and they go, stupid weather guy said it was going to rain. No, he didn't. Or she didn't. They said there's going to be a 60% chance, which isn't a 100% chance. Then they'll say 30% chance of rain, bring your umbrella. You don't bring it, you get rained on. Stupid weatherman said it was only a 30% chance. That's not zero. That is not a 0% chance. So in these kinds of conversations, you have to pick up where Mike says the probabilities favor if this happens. And then put it in your head, that didn't happen, so the probabilities don't favor that. In both directions. Both directions.
Correct. And the probabilities still favor some sideways to up move in the very short term. We might never trigger, and we could have a positive return in September. You had, if I'm looking back at that other chart, we had still 42 up months compared to 52 down months. So, do we have to have a down month? No. We could have an up month. Would I bet on a down month until a pattern triggers? No, I can't bet on it until a pattern triggers. But I can also line up hedges in case it does start breaking down, especially with the VIX down at these absurd levels. Hedges are cheap.
All right, let's move on let's look at the Dow real quick. It's going to look similar. So
The Dow is going to be. Oh, can I jump back to the S&P?
Yeah, shoot. Go ahead.
I want to show a monthly chart. We
All
don't
right.
normally get to monthlies,
And we
but
should, because you're only on once a month. So
here's what's interesting. We are back. We are now in potential massive double top territory. Again, this may never, ever, ever, ever happen. However, if we did on a monthly basis close below last October lows, October of 22, it would trigger a massive double top pattern. And we could even return to the area of the 200 month simple moving average and the area around COVID lows. Again, might never happen. The lows from last October might hold. But if they don't on a monthly closing basis, and this pattern is still valid, because the pattern could be invalidated before that happens, we could theoretically return to COVID lows. So I am not ruling out anything, but that does not mean I go home every day worry about that, because that's a far long shot away, and again, might never occur. But that's key. You said the Dow, we have
Mhm.
a massive monthly double top that could return us to the area a little in front of COVID lows, but the area of the 200 month on there. Even with the NASDAQ, that could return to easily COVID lows just with the first target area. So those are some monthly outlooks. You don't have a big, good pattern though in the Russell. The
let's
Russell's
put
the
the
weakest one.
well, let's put that S&P monthly up again, because what I want to show people here is to go from where we are now to those October lows, and it would be a monthly close. Correct me if I'm wrong, Mike. It would be a
Correct.
monthly close below those October lows that would trigger the probability being in favor of that next leg down that you have shaded in those pastel colors below, right?
Mm-hmm.
So that's 22%, almost 23% down from where we are now. So people think that's just crazy. Well, think about that. Okay, first of all, think about the sort of mood or sentiment that would there be in the markets if we dropped 22, 23% in the first place. Certainly wouldn't be bullish sentiment at all. And you start thinking about the different economic scenarios and earning scenarios that would cause that first move in the first place. Don't think that you can't drop all the way down to that 200-month moving average once you've already dropped 22, 23%, because the mood of the market would be completely different. Momentum would be shot. Consumer confidence would be shot. Likely the earnings dynamic that we have right now would be shot. So those kinds of things can and often, I shouldn't say often, sometimes do happen. So never dismiss this kind of thing. Just keep it in the far back room in your head that Mike mentioned, that that's where things would be going if we broke the October lows.
Yeah, and I'll give you just play devil's advocate. See, right in here, back, all right, we had the COVID lows, and this is monthly. We had a pullback. At one point, we had a potential double top. That never triggered, okay? Never triggered. But had we come back down and taken out the October lows in 20, then I was watching that closely, because that could have meant something else was going on and we could start backfilling those COVID lows. But this is my example. This was invalidated within a month and that pattern disappeared. So okay, if we took out this level, I got to be prepared. But the trend was still up. So you got to still trade with the trend unless you hit those key levels, and then something has gone wrong. So you got to manage your portfolio and your account appropriately.
And you put the Dow back up if you want, but I'll relate it to weather again, because I live in Southwest Florida now, and a year ago, a little more than a year ago, we had a once in a 100-year storm here. And I've lived here, I lived through that storm. And as I was talking to people who had been here 5, 10, 15, 20 years, they were saying things like, it never hits us. It never hits us. And it hit us, right? Well, those same people, as this last storm passed us to the west and continued on north and hit up in the peninsula area Northern Florida, those same people were saying, here we go again, because it had just happened. People have very short memories to disasters, and then those memories fade and they forget very quickly that these things can happen. And that, to a certain degree, is what technical analysis is about. Looking at the probabilities and saying, there's a possibility of this happening. And if that possibility comes to fruition, there's a probability that it's going to extend this far. And that's what you're looking at, whether that means protecting your portfolio, getting into things that you wanted to get in now that's cheaper than it was, or even exiting things that you made quite a bit of money on.
Exactly. So that's all
Right.
this is it's and if you learn to analyze the market, both sides, that helps keep it. It's like watching multiple news channels instead of, only one, or one leans one way or one that leads another way. At least you're going to get a perspective from both sides. That's why I always do the bullish analysis and the bearish analysis. Just because I have a bearish analysis does not mean I'm bearish. It just
Right.
means if this happens, I got to be prepared. And if we're going down, I could also have a long term, because look, long term, the markets do recover. But that doesn't mean in the short term I'm bullish. It means I'm going to be watching for a long term setup to then get bullish again.
You look at something like the jobs number, right? We had the non-farm payrolls number this past Friday. And inside of those numbers, people were pretty positive that the numbers were, I don't know, decent, right? People keep saying things like jobs are still strong. This is from Mike Singleton over at Invictus Research, and there's his website down there, invictusresearch.com. Every month of 2023 has seen substantial revisions lower on the non-farm payrolls. So for people who are saying, well, payrolls are still strong, employment is still strong. Yes, but it's less strong, and it gets less stronger with every revision. So people will sit there and say, well, how can there be a recession, with jobs still strong? Well, jobs weaken. That's one of the ways it can happen. How can there be a stock sell-off when earnings are still strong? Well, they weaken, and that's the kind of thing that can happen. And that's why when Mike is putting, I'm going to stop sharing now. When Mike is putting up a monthly chart, it takes a long time for these things to develop. And he's making you aware of things that could happen and things that may be developing, but don't have to develop. That's really all we're talking about. All right, let's go with this Dow chart. What do you see on here?
Again, the three of the four majors, the S&P, NASDAQ, and Dow, both have the major monthly double top patterns. So and all of them, if you take out the last October lows, it's not good. Other than that, so I just wanted to get that out of the way. Other than that, the key line in the sand on the Dow right now that I am watching, let me just change something around here, because we just actually finished some key probabilities to the upside for the Dow. The key level on the Dow, and you see the 200-week moving average coming in about 31,600. And remember, these levels are going to change on a week-to-week basis. At least the 200 is. But unless we go and take out the July highs, that's when the highs were made in the Dow. The key pullback areas I will be watching are 32, about 225 area, and then 31,325, 31,326. We close below 31,326. It's then the moment for the Dow. And then my target, so we would also be closing below the 200 week, which we only closed below for last October for a couple weeks and then rebounded. And remember, a moving average is an area. It's not like a brick wall. So I watch for stuff. What is not, unless we take out July highs, 31,326 on a weekly closing basis, we close below that. The most likely probabilities are we return to about 29.5, which is in the area of the October lows. And then if we were to get a close below 28,635, that's the moment for the Dow. Other than that, the trend is still up, choppy to up in the short term. You can start watching the lows from the week of August 21st, which is in the vicinity of the 50-week EMA I give it a little more room, about 33,900. You start getting a weekly close below there, could be starting the bigger pullback in the Dow.
Let's take a look at the NASDAQ. I think a lot of people are very interested in the NASDAQ. And if you could, Mikey, if we break the highs in the NASDAQ, what is your sort of projections for maybe the first place that people should place their covered calls above, for example?
If we break which highs, the most recent highs or the highs
The
from
all-time highs.
the all-time highs? If we
Yeah,
break well, funny enough, I already have them on the charts.
I figured you did.
Because you have to be prepared.
Right.
And the trend is still up. Even though if we trigger some bearish patterns, there's fundamentals are getting out of whack, but they can
So
be
let's say
more out of whack.
somebody's selling some calls on the queue or something. Where would they be on the queues?
The intermediate level, if we broke above 767, would be around 17,550 and then 18,300.
Okay.
That's
Those
why
are
I
you
like
call sellers. Be careful below those levels because they're probably going. What do you got, Mike?
So that's why I like this stuff again, because now I already have, should we keep going up? I got levels plotted out. I got probabilities of those levels. Short term, choppy to still up. We still have probabilities higher in the very short term. Now, if we start getting above 15,700 again, we get above 15,700 and then we get a weekly close. Then we get a weekly close below 14,609. That's the moment.
You need both of those things to happen?
Yes, we need to get above. Let me give the exact numbers again. It's 15,699.50. So I just remember 15,700. If we trade above there and then close on a weekly basis below 14,609, that's the moment in the NASDAQ that you really don't want to be long. Why? Because we could easily see a pullback to at least about 13,200. And then if we continued and the major below, and this isn't, all right, if we go out and make new highs, these levels will change. But the current level where it gets really yucky is below about 12,550 on a weekly closing basis. And then I'd be watching for the October 22 lows. And if those trigger, it's goodbye.
By the way, this is one of the things that, like, Jim and I have this running sort of argument. He already lost the $1 bet to me and Cameron Dawson that there would be one more rate hike. That one more rate hike happened. But, when you look at, we have a situation where inflation is still around 4% and unemployment is still at 3.8. Point in that dynamic where the Fed should be cutting rates. Like, people think that the Fed is going to start cutting rates in May of next year. So that means by May of next year, the Fed has to believe we're on our way back to 2% and jobs need a little boosting. When we haven't even got to a point where one Fed speaker at this point, granted it's 9 months away, 8 months away, whatever it is, but we haven't even had one Fed speaker say that jobs are starting to loosen up and we think that trend will continue, or wages are starting to calm down. We just had the UPS drivers get a huge raise. There's a couple of other strikes online. The Hollywood strike, actually, I don't care about that. But you've got all kinds of things going on in labor where they're still demanding more money. And this idea that somehow, and now you've got crude oil. We'll look at crude oil right after you look at the Russell. But now you've got crude oil just charging back toward $90. And you just had today, well, I'll save this for crude oil. Go on. Let's keep talking about this.
We already went for the bullish case. The key thing is we've already hit one of the probabilities. One of the things that I talk about this on the YouTube live streams all the time. If you close on the higher time frames above the 62.5, there's what I call the 87.5% rule, where the probabilities start really shifting to tackling an 87.5 harmonic, which we've already hit in the NASDAQ. But if we take out that 87.5 harmonic, which was around, it just happened to be right around 16K, then the next levels, then see we don't have a lot of bearish patterns still. We could hit 16,325, then take out the highs potentially. So that's the other side of it. The 87.5 was exactly 15,982.25. The high back from mid-July was 16,062. So you see it just spiked above there, but never closed above that level. You can have spike throughs, but we're watching especially on the weekly basis, a closing level. You see it only 1 week went through it, and then that's been the high so far. But you
And now
get
the
that
market
week.
is kind of deciding if it's going to have lower highs and lower lows or higher highs and higher lows. It hasn't
Correct.
decided yet in that short
We're at
little
a
area.
major fluctuation point.
Yeah. Okay, cool. Let's take a look at crude. And I want to blurt out what I was already saying. Because, again, by the time you guys are listening to this, you already know this, that Saudi Arabia and Russia this morning, and again, we're recording on September 5th, Tuesday afternoon. Tuesday morning, both Saudi Arabia and Russia agreed to extend production cuts through December. So that's 1 million barrels from Saudi and 300,000 barrels from Russia, which there's some debate as to whether Russia's actually cut those barrels because their exports from July over June was 300,000 barrels higher. So they may not have cut it. As a matter of fact, some people say they might have slightly increased production, but at least their jawboning is about more production cuts or extended production cuts. If there's any spike in activity out of China at all, and by the way, people are ignoring the economic spike going on in India in terms of commodity purchasing, but if there's any spike in China at all, or if our economy stays strong, crude oil continues higher. So what are you seeing on the charts? And that's fundamentally. Now, if I say, well, somebody says, where are you going to buy it? I'd be like, I don't know. I got to call Mike and ask him. So what do you see on the crude oil chart?
Well, remember when we were on with Jim last month, we talked about it chipping away at this key level, and we wouldn't be surprised to see a pullback.
Yep.
We got a couple week pullback, holding on a closing basis, the 50 EMA turning up, holding on a closing basis, the rotation zone between the orange and the blue line. So this was a couple week pullback into the weekly rotation zone, and then the end of August, strong rotation up, following through so far. My minor target, these targets haven't changed since the last podcast, I don't think.
Right.
It was 85.80 area, 85.83, which was the high from last week was 86.06. So this is the kind of thing, all right, stop raise. The next key cluster, which is at least a stop raise, is about 88.40, 88.50. And then beyond there, 92.61. Where it gets real interesting, you start getting a close above about 94. Targets are 97, and between 97 and 105, that's a major rollover zone. If you get a close above 105.50, something's going on in the world because crude could be returning to the Russian invasion high area.
Yeah, and this is, again, if you guys want to watch, Mike's on every month, beginning of the month. So whatever the first podcast, near the first podcast release of the month, sometimes there's overlap because of when we record, when we release. You can go back and watch the section on crude oil and see what Mike said versus what he said now. As a matter of fact, maybe I'll try and clip the two together if I can find it, if I can find where you said that.
And remember when even months ago, remember how I said, look how much we've bounced off that 200 week. I said the only way I could get really bearish again was if we closed below the 200 week. Look how many times we hit that, and then it formed a bottoming pattern. We started to break above the 75 level, and then we went on that multi-week run, couple-week pullback, and then a push higher, getting above all major prior resistance around that 81.75 to 82 area. So that, even on a pullback back there, that becomes support. Now you start breaking down from there. It somewhat gets a little more interesting and does not favor the bullish case as much. And then the key line, the sand, at least at this point, and these numbers again will change, but at this point, my key area, if we went below 72.80, uh, something's going on, and I don't know, maybe the economies are falling apart, there's a global slowdown, who knows. But that would then be okay, we're going to watch for that 200 to hold. If that 200 week does not hold, then watch out below. So until those things happen, I got to be watching for any kind of pullbacks and shorter term bullish setups to say, okay, let's try to trade with a trend on crude, because the trend
All right.
is still higher.
So unfortunately, we're coming up against the clock. I wanted to do some sectors. I don't think we're going to get time to, but can we go through in sort of a rapid fire way
Yep.
the 10-year note yield and then gold? I think those two are pretty critical.
And I could do these quickly. Gold?
Okay, just you talk, go through all of it. I'm going to sit.
Gold. Key line in the sand. We've got near the 50-week EMA, exponential moving average. I am watching for this bottom area to hold because I'm watching for a longer term, more substantial bottom. But if you close below 1900, we could easily be pulling back to 1810. All right, so that's the key line. Watch 1900. Other than that, I'm watching for these bottoms from back in about the third week of August to hold. What other you wanted?
10-year note, either yield or price, but I'd rather do yield.
Yield. Hold on 1 second. Where's my 10-year yield? Right here. 10-year yield is still in bullish case. We pulled back to the weekly rotation zone, have rotated up. The key line in the sand I'm watching in the short term is only if we close below about 3.95 on a yield basis. We close below 3.95, we've probably put in a major top in the yields. Other than that, we have not. If we break back above these two top areas coming in about 4.3 and a half, the next targets are 4.6. Those are the next yield targets higher. So I am not in bearish mode on yields at all unless we get below that 3.95 on a closing basis. You wanted a couple sectors. We already talked about crude, XLE, very interesting. The energy sector. The key line in the sand is, if you're looking at energy or energy stocks, at this point, we just completed roughly the 87.5 rule to the upside. The only thing, and I'm just going to project, because if we go up to even tap out the most recent highs, highs from last November, if you start breaking down below about 82.50, I'm no longer in the medium term bullish on energy stocks as a whole. There might be outliers in there, but I'd really be watching about 82.50 on a weekly closing basis. Everything shifts. And finally, technology. With so many people, technology, we are in potential double top area.
This is a great chart because this almost illustrates all the other potential doubles you talked about, but this one's a little bit more developed, although it's still not a double top.
This is technically.
Oh, okay. I couldn't tell from that small image.
Yeah, the level had to be 177.51 on a high basis. 177.38. So no, it's not. Sorry, I was preemptive with that. If we get above 177.51, which we could very well do in the next couple days, we are in double top territory in the short term. And then you have to watch the close below 162.94. All right. That's why I have this on there just for the sake of this. And that would also be a weekly close below the rotation zone. Then it's a potential pullback all the way to roughly the 145 area. If we close below 138.65, you could easily see a return to last October's lows in technology. What's interesting also,
if you look at XLK that you're looking at,
XLK.
Okay.
And just as a point of, if then you were to close below last October's lows, and this does not need a rally anymore because it's already in place, but if we were to close below last October's lows, it's major trouble for technology. And we could easily return to the 200 month and the COVID lows. So, again, not saying it's going to happen, but that's it. Now, if the rally continues in, always like to do both sides. Well, because it's not. Hold on. If the rally continues, this was set up for the weekly charts, but the next cluster area, if we do break above July's highs, the next cluster area in the XLK, 185 to about 186, and then 193 are your next major targets higher. So there you go. There's your bullish and bearish short-term and longer-term potentialities.
Mike Arnold, Chief Technical Strategist, co-founder, Path Trading Partners. Where can everybody find you? Tell everybody what you do and how they can kind of engage with you.
Best way to do it, just search Path Trading Partners on YouTube. There's a live stream pretty much Monday through Friday every day, unless extenuating circumstances. You can always jump on. Everybody's free to ask questions. You can even say, if you're new here, hey, I heard you on the podcast. What are the current levels? And I will respond. There's plenty of people in the chat.
This is also Path Trading Partners YouTube channel is also one of the places that this podcast drops when it's released. So make sure you subscribe to that and follow us wherever you watch this podcast. Make sure you subscribe to whatever system it is so you know as soon as these things drops. Follow Mike on Twitter. I think it's MG Arnold?
At MG Arnold, yeah. At MG Arnold.
MG Arnold on X. Bob_Ichino on X. Say hi to Jimmy on his mandatory vacation. You would think the Italian guy probably went away for a little while, but he didn't go away. He will be back next week. Thank you, everybody, for watching. We will talk to you next time. Thanks, Mike.
Thanks, Bob.